solo GPs. That's something that was kind of a new thing in the last 5-6 years. What's the outlook, Dan, on solo GPs right now?
I don't know. I don't know that it's really a thing. I'm not sure it ever really was.
What advice would you have?
Not to offend all the solo GPs here, right?
If you're a solo GP, should you be finding a partner? Do LPs care? I know when I got into this business, the idea was there was too much risk if it was just one GP, and that's obviously some people have been able to build funds doing that. Do you think they should get partners now, or?
Maybe I'll answer maybe a slightly different question.
That's okay.
Really going off what Mohammed said about partnerships.
Yeah.
And I don't think it's really changed all that much in terms of whether there are 1,000 solo GPs or 100 or 10. The idea that we have, and I think Mohammed and I think others are describing here, is that we want to be in business with people, and you described in terms of fees and so forth. You want to be in partnerships with people. And one thing that has changed, though, over the past, I just call it 20 years, because that's my observation period, has been that this business, especially endowment management, I think this sort of multi-asset class setting has become harder in a sense. It was pretty easy around venture capital 20 years ago. The market was smaller, the number of firms were fewer, the number of institutional investors playing was smaller, the amount of capital that was at play was just much lower. So it's probably enough just to say we're allocating to venture and then kind of mostly get it right about selection. Now there are thousands of firms, whether it's solo GPs or seed funds or Series A, what have you. It's a very large industry, and from our seat, we don't see everyone. And so what's changed is that it makes it more important for us when we select partners for those relationships to be based on 2 or 3 or 4 or 5 of the advantages we have as an endowment. And each of us have different advantages, but our advantages are access to people, access to information, differentiated access to opportunities, a very long time horizon. And in some cases, we have the ability to change outcomes. And that relates to emerging managers, or I don't call it, it's newer managers, where our participation can actually change the trajectory of those firms. So that's what we're looking at more, is where can we apply our advantages as an investor in contrast to let's just allocate.
Talk a little bit about specialist funds, Venus. Like, do you think the best strategy for people is to have 5 or 6 practice areas and diversify their risk across, let's say, investment types? Or should you be narrowing your scope and saying we're a crypto fund or a consumer fund? Or like, how do you think about that?
I'm going to sound a lot like an economist and say it depends. It depends on what our team skill set is in terms of picking the right sectors and knowing that we can identify talent within those sectors. And then if we are investing with a generalist firm, do they have the skill to pick the right opportunities to lean into at the right times? So I think it's a combination. We tend to lead toward picking sector specialists just because we feel like they're the ones who are going to have the strongest networks in that space. They're the ones who are going to have the most knowledge in order to add value in a given situation when brought to the table to do so, especially when sitting on boards per se. But if there is a generalist firm out there that has the right team, the right staff, in order to have the expertise to lean in and out, then that is someone that we would look at.
How about geography, Eric? Long LA?
Well, I think as you know, we put a lot of capital in LA. And kudos to you, getting the name out. You've done a great job for the brand of LA and Upfront. And good little clapping there. And I think I'm on 5 LPACs in Los Angeles alone.
Wow.
With managers. We look at geography probably like most allocators do. We have a portion of international that could be 20 to 30%, and then the rest is sort of North America, leans North American. It is interesting. I think there's a lot of clients, because the market has been so good in North America and the returns, and we'll talk about returns and DPI and TVPI a little bit later. They've been so good, they haven't had to go internationally. And with some of the geopolitical issues, I think there's a lot of pullback, particularly in China right now. People have reservations about going there, as well as the war in Ukraine. They're worried about Europe. I think if you're smart and you diversify and you be consistent with your allocation from a geo perspective, I think that's important. Venture capital is proliferated the globe, right?
Yeah.
The secret's out. It's not just Silicon Valley anymore.
Yeah. Since you went there, can you just lead us off with how you're thinking? Like, what metrics matter these days? Is it TVPI? Is it DPI? If I could do secondary to juice my DPI, do people care about that these days? Is it IRR? How do you look at the benchmark data?
Well, we do try to look at returns and peel all the layers of the onion off. There's a lot of nuances to track records. We all know. Data and charts can lie or tell a story, and you sometimes have to understand that story. Now, TVPI and IRR, you can't really eat, right? Mm-hmm. DPI matters, and I think in the market we were just in with such great exit, if our managers have not been active in that exit market, we got to understand why. One of the best markets to exit, and DPI is what helps these endowments, puts food on the table for folks. TVPI is great, but we want to see it convert. And, IRR, you can't eat that as well.
I find it